The S&P 500 has finally pushed up into a key area where it's deciding if it wants to continue higher to the upside and break out, or if it wants to break back down and push below. Obviously, we've had a lot come out recently with jobs data, retail sales, PPI, CPI. We've had some more feds come out who are hawkish and are advocating a return to bigger 50 basis point rate hikes. So a lot has changed. Volatility has been suppressed. The last several weeks have been all about scalping the market. If you played these key levels, if you're playing gap fills, gap fill reversals, gap closes, you can make a killing just trading zero dated expiration contracts. But in this video, I want to cover a bit more about what is going on in the economy, reading into some economic data and determining, if you're looking to buy a house, should you be saving more? Should you be gearing up for what could potentially be a longer term recession? Looking at recent headlines, you can see that U.S. retail sales rebounded sharply in January. And no mistake, the market has also been rallying during that period. So inflation is closely tied with equity prices. You can see here January CPI was at 6.4% and monthly inflation rose by 0.5%, which was greater than the previous month, suggesting that inflation is ticking higher. Obviously, Jerome Powell does not want to have a 1970s type scenario where we have a double dip recession and inflation has two peaks, the second one being higher than the first. You can also see that PPI was higher. So Jerome Powell definitely wants to avoid spawning another Cathie Wood, who, when we had zero interest rates, was averaging $3 billion in net inflows per month. And as rates went higher, she's been down 67% return. ARK is not the new NASDAQ. Sorry to break it to you, Cathie. Then, of course, you had people who were employed with 10 full-time jobs at once. It's quite an insane time. So a lot has to flow through the system for all of this to play out. We definitely have not seen the worst of the recession. We are seeing slower growth, more layoffs, but jobs is still strong. Today we had Bank of America lay off people, and then KPMG also laid off people. So you're seeing it not only in tech, but other industries as well. Today we do have Fed Barkin as well as Bauman speaking. If you were looking at the headlines yesterday, you had Loretta Mester and James Bullard, who are both usually pretty bearish, and they talked about the return to 50 basis point rate hikes in the future, which is why the market sold off in the later half of the day on Thursday. That was the 16th. And you can see even here with PPI, which is usually a leading indicator of CPI, because if the price of raw materials are going up to create those goods and services, then of course the actual price of the goods and services will be higher. And so that's something that the Fed is watching. We also have quite an option expiration week. 1.8 trillion. This is 740 billion of S&P 500 AM settled options, 600 billion ETF and SPX, as well as 380 billion of equity options expiring all this week. So usually when you have a significant amount of in the money call open interest at expiration, all of those close out and you have a push lower to the downside. So I don't know if yesterday's move was completely due to what Bullard was saying, but could have also been due to this. And we'll see how things play out after OPEX on Tuesday, since Monday is a holiday. And then I also want to talk a little bit about housing. So I think this is kind of on everyone's mind. You can see here that the housing price futures did drop, and then it's kind of bottomed around November, December, and has been rising again. Obviously, mortgage rates dipped down a little bit as Fed funds and futures were pricing in that terminal rates were near a top, but now because inflation is sticking, maybe they'll continue to raise rates, which would mean that the 30-year mortgage rate would go up, and housing would fall, obviously, due to that. You can see here that U.S. pending home sales has quite fallen off a cliff recently. Obviously, you had the COVID crash, and then things were pushing to the upside, and now we've had a push down again. And this was kind of an interesting graphic. You can see here that this is the 1-year price change percentage by metro area. And so if you look at all these different cities, you can see that most of them have peaked and are starting to go down. If you're looking, these are your months. You can see that in October, prices have continued to drop. Obviously, this is still a 1-year price change that's higher than the year before. So prices are still up there. You need to probably see some sort of negative amount here in some of these bigger, larger metro areas before it's actually worth buying any real estate. If you're interested in learning more about trading or just being part of a community, I highly suggest you join our Discord group. It's the first link in the description. We have a lot of other people in here that are trading. You can share ideas, just become a better trader overall. And obviously there is a free trial if you are interested in taking it to the next level and joining our premium chat room, which would give you access to a bunch of content that you can see on our website, which is also in the link in the description below. Really hope you enjoyed this video. Have a great weekend, and I'll see you later. Peace.